Imagine you are sitting at your kitchen table in Singapore. You just opened your monthly bank statement and you notice your take-home pay looks slightly smaller than it did last year. At the exact same time, your phone buzzes with a notification about global crude oil prices spiking past $110 a barrel. The global economy is shaking, inflation forecasts are rising, and you are left wondering if your hard-earned middle-class wage is slowly slipping through your fingers. Why does a stable, comfortable salary in Singapore suddenly make you feel like you are running on a financial treadmill that keeps getting faster? How do the massive policy changes of 2026 rewrite the rules of building wealth? And where is the smart money quietly moving to stay ahead? Today, we are breaking down the honest, dollar-by-dollar reality of how the 2026 budget changes your investing strategy forever. To understand where we are going, we have to look at the massive macro shock hitting the island nation right now. An ongoing global conflict has disrupted shipping lanes, and Brent crude oil soared to a high of $114 a barrel. For a highly connected economy like Singapore, which imports almost all of its resources, this is a massive supply-side shock. In response, the Monetary Authority of Singapore raised its core inflation forecast to between 1.5% and 2.5%. To cushion this blow, the government presented a record 155 billion Singapore dollar budget. But they did not stop there. On the 7th of April 2026, Acting Transport Minister Jeffrey Xiao announced an emergency support package worth close to $1 billion. This package brought forward the $500 Community Development Council vouchers to June 2026 and enhanced the cost of living special payment up to a maximum of $600 for eligible citizens in September. Interestingly, the government flatly refused to cut fuel duties. They argued that artificially suppressing prices destroys the market signals that encourage energy efficiency, and it could cause global suppliers to divert fuel away from Singapore, making the domestic supply even tighter. Instead, they are forcing the economy to adapt, which means as an investor, you must adapt too. The first major tectonic shift is happening inside your Central Provident Fund. From the 1st of January 2026, the ordinary wage monthly ceiling has officially risen to the final target of 8,000 Singapore dollars. If you are a high earner making $8,000 a month, your mandatory employee contribution has jumped to $1,600. This means your monthly take-home pay has dropped by an extra $120, while your employer must chip in an additional $102. While this boosts your long-term retirement safety net by an extra $4,080 a year, it creates an immediate cash flow squeeze on your monthly budget. But the real shockwave is the final death of the legendary Central Provident Fund Special Account shielding hack. The government has officially shut down the loophole. For anyone turning 55, the special account is automatically closed. All your high-yield savings are moved directly into your retirement account up to the full retirement sum of $220,400. Any excess balance is dumped straight into your ordinary account, where it earns a much lower interest rate of 2.5% instead of the guaranteed 4.08%. If you want to keep earning that premium 4% interest risk-free, your only option is to voluntarily top up your retirement account to the newly raised enhanced retirement sum, which stands at $440,800 for 2026. If you are looking for long-term growth, the old set-and-forget strategy is dead. Fortunately, the government is introducing a brand new life cycle investment scheme in 2028. It will offer low-cost, simplified portfolios that automatically adjust your asset allocation along a glide path. When you are younger, the portfolio takes on more risk with higher exposure to equities to maximize compound interest. As you approach retirement, it automatically rebalances towards safe assets like bonds, completely shielding you from a sudden market downturn right when you need to liquidate your funds. The next big change is a quiet, ticking clock inside the supplementary retirement scheme. On the 1st of July 2026, Singapore's statutory retirement age is officially rising from 63 to 64. Why does this minor detail matter to your wallet? Because the penalty-free withdrawal age for your supplementary retirement scheme is locked in the very second you make your first contribution. If you have never opened a supplementary retirement scheme account, you need to open one and contribute even $1 before the 1st of July 2026. Doing this legally locks in your penalty-free withdrawal age at 63. If you wait until after the deadline, your funds will be locked up for an extra year until you turn 64. Once your money is in the account, leaving it in cash is financial suicide. More than 19% of all supplementary retirement scheme funds are currently sitting idle as cash, earning a pathetic 0.05% interest. With inflation elevated, that idle cash is losing purchasing power every single day. You need to deploy those funds into productive assets like unit trusts, exchange-traded funds, or Singapore real estate investment trusts. But you must be strategic. Remember that Singapore imposes an overall personal income tax relief cap of $80,000. If your existing reliefs from your employee contributions, child reliefs, or parent reliefs already touch that $80,000 ceiling, any further contributions to your supplementary retirement scheme will yield zero tax savings. You will simply be locking up your liquid cash in an account with zero tax benefit. This brings us to the ultimate question of where to invest your liquid capital in 2026. For decades, the standard playbook for wealthy Singaporeans was simple: buy physical property, leverage it up, and watch the capital gains roll in. But the government has systematically dismantled this playbook. Even though mortgage rates have plunged to 3-year lows, with daily Singapore overnight rate average dipping as low as 0.88%, and major banks offering fixed 2-year packages at a highly attractive 1.4%, the physical property game is a minefield of taxes. As a citizen, buying your second residential property slaps you with a brutal 20% additional buyer's stamp duty. For foreigners, it is a staggering 60%. On top of that, progressive property taxes for non-owner-occupied investment properties have surged, reaching up to 36% on annual values above $60,000. These rising wealth taxes are dramatically eating into your net rental yields. This is why the smart money is quietly rotating out of physical brick and mortar and into Singapore real estate investment trusts, or S-REITs. The sector experienced a sharp 7% decline in March 2026 as global interest rates repriced. But this sell-off has opened the rare, highly lucrative window of opportunity. S-REITs are currently trading at an average price to net asset value of 0.9 times, representing a 10% discount to their underlying asset value. They are yielding a highly attractive forward dividend yield of up to 6%, providing a robust spread over the 10-year government bond. And here is the absolute best part of the Singapore tax system that almost no other country offers: the one-tier corporate tax structure. The trust or company pays tax at the corporate level, and the dividends distributed to you are completely tax-free. No dividend withholding tax and absolutely zero capital gains tax. You get high liquidity, regular cash flow, and tax-free compounding without the massive capital requirements or holding costs of physical real estate. If you want to catch the next massive growth wave, you must align your portfolio with the government's strategic focus. Singapore is betting big on artificial intelligence, committing over $1 billion to public research and talent development through 2030. Under the newly established National AI Council, personally chaired by Prime Minister Lawrence Wong, the nation is building a world-class artificial intelligence ecosystem. They have already launched Soaring AI, a buzzing, collaborative hub in Chinatown, and Launchpad at One North that has seen over 4,000 practitioners participate in modular training programs. By 2028, the government will complete Kampong AI, Southeast Asia's first integrated startup park, featuring 14,500 square meters of workspace for up to 70 artificial intelligence companies, integrated with 200 residential units under one roof. For business owners and investors, this represents a massive opportunity. Under the Enterprise Innovation Scheme, businesses can claim a stunning 400% tax deduction on up to $50,000 of qualifying artificial intelligence expenditures. The future growth of Singapore is being pinned to the technological narrative, and investing in companies or industrial REITs that own the data centers and logistics hubs supporting this infrastructure is where the highest long-term returns lie. The old playbook of buying private condos, highly leveraging your debts, and relying on easy passive returns is fading away. The new 2026 playbook requires precision, It is about maximizing your Central Provident Fund ordinary account to stabilize your mortgage, topping up your retirement account to the enhanced retirement sum of $440,800 to secure risk-free 4% compounding, locking in your supplementary retirement scheme age before the July deadline, and rotating your liquid wealth into tax-free S-REITs and high-growth artificial intelligence infrastructure. If this breakdown helped you navigate the changing financial rules of Singapore, do me a quick favor and smash that like button. It helps the algorithm share this financial clarity with more people. If you are not subscribed yet, now is the perfect time to hit that button and turn on notifications so you never miss the next deep dive. Let me know in the comments how you are restructuring your portfolio for 2026, and I will see you in the next video.